Well, today's an interesting day. We're discussing bank loans for businesses. But if you don't have a track record to use against taking out a loan, what's the best course of action to get that money? Well, injecting money into a business is a necessary part for most company directors. But if you're just starting out, you may not have a good enough track record to take out a loan. The banks will probably see you as high risk. There is the option of taking the money out personally and lending it to the company, however. But what is the most efficient way of paying it back?
Despite banks improving over the last few months and the government making all the right noises, the simple fact is that businesses are still finding it difficult to raise funds, with some company directors using the full equity against their own homes as financial backing. This is a risky move, but if it needs to be done, you need to make sure you follow the most tax efficient way you can. Of course, with any loan you will need to pay interest back to the bank or whoever you're borrowing from, but the company can give you back the cost without triggering a tax or national insurance bill. Essentially, the company can help in two ways. One, it can pay you interest equivalent to the amount you're paying the bank. Two, it can convert the loan to a new separate class of ordinary shares in which it pays you dividends.
There are some pitfalls though. Make sure the company isn't paying you back in extra salary or expenses because you'll be taxed on these. So if you've avoided that pitfall, you'll arrive at the junction of taking option 1 or option 2. It really depends on how much the company you own. If it's over 80%, then it's probably best to take the loan out and receive interest instead of being paid dividends. You will in the long run save more money this way, and that's our top tip today.